of numbers to get through. Let's talk about Ugro Capital. By the way, this stock has done very well. You know, in March of this year, which is just about 6-7 months ago, the stock was at around 145. So in just that amount of time, it has almost doubled. So it's currently over 290 rupees on Ugro Capital. Talking about the Q2 earnings, it was a strong set this time around. The disbursements saw a rise both on a year-on-year basis as well as sequentially. So we have Shachindra Nath joining us now. He's Vice Chairman and MD at Ugro Capital to take some questions. Mr. Nath, thanks a lot for joining us again on the show and, going through the outlook with us. Take us through, the loan growth, the AUM growth that we've seen, because like I was pointing out, that has been quite strong this time around. I think if I look at it on a year-over-year basis, it's up almost 50% on the disbursements, 52%. The AUM has also gone up quite well. What do you expect for the rest of the year? What do you think we can see for full FY24?
Yeah, thank you so much for inviting me. As I've been saying in last many quarters, Ugro is India's first listed startup with the aspiration to build India's largest small business financing company. The AUM growth which you are seeing is a hard effort of first 3 years of our operation, where we have invested significantly both in our digital data technology, infrastructure, distribution, and very unique liability strategy which combines co-lending plus on-balance sheet lending. So as we exited of March 24, we were at 550 crore, which is around 70% of our installed capacity. And our strategy for the year was to continue disbursing same amount and monetize the existing, OPEX which we have already built. And the growth is a sheer function of our multi-channel distribution. This year end, if you look at, we have guided that we should be somewhere between 9,000 to 10,000 crore. Yeah, and that's a function of our 550 crore of average disbursement per month, of which 50% is off balance sheet, 50% is on balance sheet. And what we are seeing now is the operating leverage to kick in, because this company pre-COVID was a 120 people company, post-COVID it was 1,1700 people company with massive investment in almost 275 people in data analytics plus technology. So now the operating leverage has kicked in, because now you are seeing a sheer AUM growth with OPEX more or less remaining the same.
So last time you had spoken about ending FY24 with an AUM of 10,000 crore. Is there a downward bias to that? Because now you're saying it'll be 9.5 to 10,000, or are we just...
Yeah, so I think a lot of people keep telling me that why you give such a hard numbers in public market, you should not be doing that. I'm also trying to myself and learning more, what to say, what not to say. We like to give very high aspirational target, and which is more for ourselves than most for the market. I think so we are very clear that this year we have to deliver defined bottom line number, because we are compared to very established players, which are, there in the market for 20 years and 30 years. So reason why I said between 9 to 10,000 odd crore, because it's a function of, sequential month on month disbursement. We are still gunning for that, aspiration number of 10,000 crore. But we are clear that if we miss it by 400-500 crore, we are still right now on our AUM target, we are short by 300 odd crore. Even if we miss it by that, but we deliver better bottom line performance, we are okay with that.
So you spoke a lot about operating leverage kicking in. What is the outlook on the net interest margins? The calculated NIM is at 7.81%. What can you end the year with? What is the aspirational number on your net interest margins?
I think it will remain the same range. We are not seeing improvement in net interest margin at all, because as we mature more, our cost of borrowing, which has remained flat all through last 3 quarters, should start tapering down a little bit. But as of today, we are expecting our NIM margin to remain same. But the operating leverage is a function of that there is no incremental OPEX to get the incremental AUM.
Okay, got that. So you're saying NIMs around what, 7.5 to 7.8? Is that a band to consider, Mr. Nath?
Yes, I think so. Our NIM would be in the range of 7.5%.
Okay, around 7.5%. Got that. Let's talk about asset quality, because it's been a very minor, small increase. It's hardly 10 basis points actually at the gross NPA level. Just tell us what you're seeing in terms of trends, because also simultaneously your provisions are up. I think they're up almost 17% even over the first quarter sequentially. So yes. Why the need to hike provisions? What are you seeing on asset quality? How do you see your restructured book moving ahead?
Yeah, our restructured book is very, very marginal now, and it is completely performing. So we don't see anything additionally to come from the restructured book. the incremental 10 basis point of increase in gross NPA is a sheer function of most of our portfolio now coming to level of maturity, and this is what is on the expected line. The way we have constructed our portfolio is to deliver less than 2% of credit cost. And that's why, unlike of some of our peers said, we do, 18.5% of business loan unsecured, which is 30% of our portfolio. But we also do a very significant business at 12.5%, which is our secured business. And we have an expected credit cost by all of our channels, and that deliver a combined credit cost of 2%. So I think so we are in the range. We think that the gross NPA numbers are, will incrementally inch up a little bit because of sheer maturity of the portfolio, but our credit cost would be in the band what we have projected.
All right, got that. Mr. Nath, it's a pleasure having you on the show, and we do hope to have you back on very soon. Thanks for joining us today. That is the management of Ugrow Capital. It's been a strong quarter for the company, and they're sounding positive on the outlook going forward as well. It is time for a short break on that note, but we'll be back with lots more.